Hello friends. In addition to analyzing attitude of the market players, we need to pay attention to the internal strength of the market as well. Using the market data, we identify the internal strength of the market, which will help us to identify whether the market is improving or deteriorating. There are multiple options. With the market data, we'll examine how the technical analyst will measure the internal strength of the market. There are multiple tools available like the number of stocks advancing and decline using or measuring using the volume of winners and losers using new 52 weeks highs and lows, and we have market averages like SPY and Nifty. What is the position of this market average in comparison to moving average of those averages? There are plenty of indicators available. Pretty much you all aware it's overwhelming, right? It's not what technical indicator you apply or when you apply the technical indicator. It is all about which specific technical indicator you apply in the right time. Because technical indicators are grouped together as trend-based technical indicators and sideways market technical indicator for sideways market. For example, ADX is a trend-based technical indicator, and there are oscillators which will be used in case of sideways. So it's not appropriate to use trend-based technical indicator during sideways market and vice versa, right? So we cannot master all the given technical indicators. Identify few technical indicators, for example, ADX for trend-based market and stochastic for momentum and volume-based technical indicator for confirmation, namely OBV, like that. So what we are going to discuss in this video, we are going to focus on measuring market strength. It is pretty significant. Why it is pretty significant? Because market may be climbing up higher. Is that high all because of all the stocks in the stock market or majority of stocks in the stock market? Or only the few big players contribute to this high? How can we do? How can we identify? How can we know that? So measuring market strength is significant for this specific situation to measure the real strength of the market. So without much delay, we'll focus on measuring market strength in this video. Sit back, focus, and continue. For a given day, a stock can advance, decline, or stay unchanged. When do we consider a stock as advance? When the closing price of stock is higher than the previous close, then it is advance. When we consider as decline, when the closing price of the stock is below the previous close. Unchanged, when the closing price of the stock is same as previous close. This cumulative advance and decline is considered as market breadth. There are multiple tools for market breadth which we are going to see one by one. Before we proceed with measuring market strength or understanding breadth of the market, we need to understand a significant concept called negative divergence. We already discussed this in our confirmation chapter. Negative divergence, positive divergence, negative reversal, positive reversal, failure swings. All those we discuss in our confirmation chapter. I just refer it in the suggestion section. You can see the video, you can see somewhere up, and you can refer those confirmation video to understand this concept. But negative divergence is pretty significant right here. The other concepts you can refer the video, but negative divergence, there are two kinds of divergence. One is negative divergence. This we call it as negative divergence. And the lower portion is called positive divergence. What is negative divergence? For example, if a stock is making series of higher highs, this is high and there is a higher high, and whereas the indicator or breadth indicator, whatever the indicator it is, oscillators or whatever it is giving lower highs. Stock is giving higher high and indicator is giving lower high, then it is negative divergence. Meaning the highs mentioned or appear in the stock it's about to come down, which is what negative divergence implies. And significant point you need to you need to refer here is negative divergence is always compares the highs, whereas positive divergence always compares the lows. For example, the stock is making lower low, but the indicator or oscillator is making lower highs. Then in that case, this is positive divergence, which happens comparing the lows of the stock and lows of the indicator. Here we can see the confirmation. Before going to confirmation, what is the implication of positive divergence? Though the stock is making lower low, the indicator is signaling that this is the final low. The stock is about to climb up higher. That's the indication we receive from positive divergence. Confirmation, stock is making higher high. Negative is also making higher high, which is confirmation that the upward trend continues. Stock is making lower lows and indicator is also making lower low, mentioning that the continuation of bearishness is there. Oh, now you understand negative divergence. Significant point we need to understand before we proceed with breadth. This breadth line or advanced decline line is the most common and best way of measuring breadth and internal market strength. This line, this blue line you see, this is the breadth line. In the top portion you see SPY. Similar to Nifty in India, this is one of the index used in US. There are many other Dow Jones index, Nasdaq index, but this is SPY index, pretty much you all aware of. So what is the breadth line for this index? This is the blue line, is the breadth line. How this line is calculated? This line is the cumulative sum of advances minus declines. You can see the formula here. Number of advancing stocks for a particular day minus number of declining stocks for the particular day. This will give advance decline and will create it as a cumulative line plus breadth line value for the previous day is added, which will create a breadth line value for the current day. When breadth line will rise on day when the number of advancing stocks exceeds the number of declining stock. When breadth line will fall on days when more stocks are declining than advancing. Breadth line can be constructed for any index, industrial group, exchanges or basket of stocks. And again, breadth line can be used in daily chart, weekly chart, whatever the chart you use. Normally, the breadth line should roughly replicate the stock market averages. You can see here, right? So this is the stock market average, SPY, and both this breadth line and the stock market average looks similar almost. When stock market falls, breadth line as well fall. When stock market rise, breadth line as well rise. How to trade? What is the technical analysis of breadth line? What is the significance of it? When breadth line fails to replicate the average, and what happens? That creates divergence, right? Meaning only few stocks are fueling value, but the majority of stocks are either not participating or declining in value. Meaning we can expect downfall in the bullish market. In the bearish market, we can expect an uptrend. The breadth line derived only from common stocks generally has more reliability than only including all stocks. Breadth line should consider only common stocks. There are preferred stocks, mutual funds, ADRs, many other non-productive companies. So make sure like breadth line is not diluted. Only the productive companies should contribute breadth line. Only then it will be reliable. For example, we have Nasdaq index. Nasdaq index is a capitalization weighted index. You are aware. Like if there are big companies play major role in Nasdaq. It's a blue chip index, right? So technology company like Apple, Tesla, and Facebook, Microsoft has major contribution in Nasdaq. In those kind of scenarios, few stocks, that is this major players, contribute to the increase in the stock market. However, breadth line will create divergence. So that may not be a realistic scenario. Only the survivors contributing to the rise of the stock market average, which is not in the absolute form. It is useless. We'll make sure only all the companies in the average or all the companies we consider for calculating the breadth line are productive companies. So that will completely we can rely on without any defects. We can rely on the breadth line or advanced decline line. McClellan oscillator. So how it is calculated? It's basically the difference between two EMAs, 19-day EMA and 39-day EMA of what? Advance minus decline. First, advance minus decline is calculated for every day and the average is derived. What is that average? 19-day EMA and 39-day EMA. The difference between two average is created as oscillator. Self-explanatory. If it is green, market is rising. If it is red, market is coming down. McClellan summation index. This is basically accumulating the daily McClellan oscillator figures into a cumulative index. Again, it's easily understandable. If it is green, market is rising. If it is red, market is falling. So there are few more tools available. This is McClellan ratio adjusted oscillator. How it is calculated? The ratio is the net of advance minus declines divided by the total of advance plus decline. Once it is calculated, the adjusted ratio is then calculated using the same exponential moving averages as in McClellan oscillator. Why they use ratio? Because these days the number of stocks in an index is too much, like 3000 plus or 4000 plus. If we are calculating difference between hundreds, for example, assume if there are only 100 stocks in an index, there may be some advances, few were advancing, few were declining. The difference will be in tens. But if it is in thousands, the difference will be huge. So if we create the ratio, it will be easy to plot. Otherwise, it doesn't make sense. We need to expand or it doesn't make sense over the period of time. So that's why they calculate ratio adjusted oscillator. Next one is plurality index. It looks at the absolute sum of the AD difference over the last 25 days. Absolute breadth index, this is the ratio of raw difference between advances and declines divided by the total issues traded. Total issues traded is the denominator. Unchanged issues index, ratio of the number of unchanged stocks to the total traded. As I initially mentioned, there are so many tools, so many indicators, oscillators available. Pay attention to the significant one which is working. For example, if you take this unchanged issues index, these days all stocks change, right? Where are the stocks? How many stocks make unchanged? And if there are few stocks makes unchanged, not making any change, is that a productive stock to be considered? No. So pay attention to the significant one. You need not to be, you be aware of all or as many indicators available, but be master of only few indicators which is working for you. There are few more breadth related indicators and oscillators which I'll cover in the next video. Thank you for sticking till the end of this video. I have notes for this video captured in the description section. Please download and make use of it. Thank you guys. See you in the next video. Bye bye.